Meeting. All right, folks, my next guest says that scarcity causes inflation. I'm going to bring in now Walser Wealth Management President Rebecca Walser. All right, so let's talk about that. How does that work? Can we bring that back down, the scarcity thing? Yeah, let's take a look at that. Scarcity leads to inflation. Walk us through this.
I mean, basically, it's the law of supply and demand. It's basic economic principles, Charles. So in your example with tariffs, if it is causing job layoffs, then people don't have the money, so they're no longer in the purchasing power of demanding things, which obviously is a counter to inflation. So you can look at the inflationary pressure that it could cause, but it has other economic impacts which are being disregarded by the financial media that only wants to talk about the price increase part of it alone.
Right. And you can increase the price, but if someone can't pay, they can't pay.
They can't pay.
Bottom line. And
That's
if they don't pay, then that means the economic wheels don't move. But I hear people talk about other things, right? So let's talk, for instance, there's money supply, the purchasing power of the dollar. We hear people talk about this, right? So what about all the money printing?
Yeah, this is the basic example I can give you is when we were accommodative between the global financial crisis and really when we started hiking rates in 2022, right? So when you had Fed funds rate at 25 basis points for such an extended period of time, you get mortgages at 2.6-3%. You can afford a $600,000 house because the monthly payment is a lot smaller, and that pushed housing prices up. When rates go back up to maybe a more normalized 5 to 7%, I can now only afford a $400,000 to $450,000 house. So basically, low interest debt actually gives me more ability to purchasing parity, right, and that shifts prices up.
What about the notion that this is not even about prices as much as it is about the dollar? The dollar not having any purchasing power.
That is exactly right. I mean, if you look at the chart, obviously you're going back to the beginning of the Federal Reserve here in 1913, and you can see that we've done nothing but lost purchasing power, and this is a direct result of our 37+ trillion, almost $38 trillion of federal debt.
All right, you just brought up debt. Let's bring it up. Let's bring up a debt chart, okay?
Yeah.
So this is global debt.
Yeah.
323 trillion and counting. I mean, I know one day there's a reckoning. I just don't know when, and it feels like because there hasn't been one, this chart is just going to keep going up and going up.
Yeah, I go back to the Titanic, where that scene where the propeller just it goes until it doesn't, and it is an abrupt stop. So the world has been able to assume and consume this debt and continue to move the needle forward, but there is a reckoning coming, and I think the reckoning is really tied to the fact that we are moving from traditional finance to new finance, which will be obviously on the blockchain.
All right. Let's talk about what the Fed can do, because there's members of the Fed are worried about inflation, but I don't think they can do anything about beef and veal prices, which is up 15%, yeah, car maintenance, home insurance, electricity. In the meantime, gas has come down, eggs have come down, IT services. I mean, the folks here on the Fed who are so focused on inflation as opposed to jobs, I don't know why they think they can do anything about some of this stuff.
Well, they have contradicting mandates, and that is always their problem. If they're accommodative to support businesses to not have layoffs, then they're going to be accommodative and push prices higher because it's too much money supply. So it's a dually mandate, and that is the problem.
Let's talk about the market.
Yeah.
So you've been saying that the market sort of, I think the term you use it, we're at the pricing stage of the new frontier. What does that mean?
Well, we haven't monetized AI, robotics, quantum computing, and the blockchain. So as it monetizes, we'll go from estimation of value to realization of value, and that is always prickly. It is always 2 steps forward, 3 steps back. It's always volatile, and investors just need to understand that, be prepared for it, accept it as part of the process.
So we shouldn't be afraid then. I mean, it's
absolutely not afraid.
It invites the volatility that we're dealing with until we get the known. But there will be a known. There will be some value there.
Yeah, it's the same. I mean, if you said, hey, I was right about .com and I had negative returns in 2000, 2001, 2002, then you missed out on all of the upside that came after that as we actually got e-commerce to monetize. So you cannot avoid it. You just have to accept that it is going to be rocky until we get to a true valuation.
And you're still holding your NVIDIA.
NVIDIA, absolutely.
2 ideas. Visa and General Mills. Let me do General Mills because we've got 20 seconds before I hand it off. Is this about safety? This
is a stock that is basically, a stability. It's a consumer staple. As we get people that are scared, this is a great play. It's a 5.22% dividend raise for 5 years in a row, only on 45% payout. And I think it's a long. I just want to say really quickly about Visa. Visa is doing something with the pilot program, paying businesses paying in USDC stablecoin, and that is where they need to go. We need traditional finance companies to embrace the future. If they don't, they're going to get left behind.
You
yes,
got it. Thanks a lot,
absolutely.
Rebecca. We got it all in, Liz. And look, we get a little